Now, Pfizer is a global biopharm company that focuses on research, development, manufacturing, and distribution of both medicines and vaccines. And when we take a look at the performance of this company, in 2024, it is down 12%. But even if you've been a long-term shareholder, you would be down 20% over the last 10 years. Now, right now, it's trading towards its 52-week lows and offers an incredibly attractive dividend yield near the 7%. So is this one we should consider for massive opportunity in terms of share price growth, very high dividends, or could we see a potential dividend cut and other issues that could factor this company over the longer term? Now, we can take a look at some of the reasons why this company has been punished by the market, and the first one here sits at the fact that both their revenues as well as their margins have been declining over the last few years. And remember, high quality companies on this channel often show us the opposite, an increase to their top line and an increase to their margins. We also get another reason here, an activist investor, very popular. We have covered them before on the channel. Starboard have around a 1 billion position in this company, and they've taken a look at this company under the covers, and they've seen that they've overspent on quite a number of their recent acquisitions that they've been able to do with the vast amount of cash they did generate from the COVID period. However, having said that, when we do take a look at the earnings that they did release in just the more recent quarter, we can see both their revenue as well as their EPS blew past analyst expectations. They also hiked their full year outlook, which was very positive. Remember, that is what the market wants to see. And when we take a look at the actual numbers, well, we can see EPS very strong, $1.06. The market was waiting for 62 cents, and the revenue looking very impressive, 17.7, higher than the 14.95 again that the market was anticipating. And we can see EPS has been increased 275 to 295. It was anticipated 245 to 265, and the same increase in terms of EPS is also reflected in their revenue above the 60 billion mark, 61 to 64, with analysts anticipating 59.5 to 62.5. We can also see their bottom line for the quarter, the net income came in at 4.47 billion, which is a massive improvement from the net loss that they did report of 2.38 billion in the same quarter last year. In terms of their expectations moving forwards, it does look a little bit inconsistent over the next 4 quarters. Only one of them they're anticipating to be an increase, and in fact that is the Q4 of 2024. But what we do like is that over the last 4 quarters, management do have a 100% track record, having a beat every single quarter. As we just mentioned, a very sizable one in Q3. But we do have to flag here, over the next full accounting period, December 2025, the EPS is actually anticipated to drop, there in turn marginally increasing the forward P to 8.76. Now, we just want to flag a few things from that very strong quarter that they did have. Their revenues are up for the quarter whilst lowering their cost of sales, which is very impressive because ultimately what that means is that the gross margin is improving, something we do like to see. And as we already took a look at, their earnings per share was also up in comparison to the same quarter last year. In terms of their allocation, we've already touched upon this in previous episodes, but as a very quick highlight, this is a company that does pay out a significant amount of cash to investors through their dividends. We're going to touch upon a dividend increase that they did just have and released yesterday, and we can see one thing we like with companies, we don't see it often, they are looking to delever their balance sheet, pay down a lot of debt, and as we can see year to date, they've done that by around 4.4 billion. Spent just under 8 billion in terms of internal research and development. And one thing that we do want to flag here, even though nothing is planned for the year, is the share repurchases, as that is something we will draw your attention to see how that has impacted the company over the last 10 years. And after one of their most recent acquisitions, Seagen, again, we referenced this in previous episodes, what they're looking to do with their capital allocation moving forwards is a little bit more balanced, both between reinvestment, as we can see they've done a significant amount, but also returning value to shareholders, which we do anticipate the main focus will be through those dividends, as that is one of the key drivers for investors in looking at this company. And as we've already highlighted earlier, they increase their outlook for their revenue as well as their earnings per share. So overall, looking very impressive for Pfizer. When we do take a look at the actual numbers, we can firstly see dividend safety score 75. This is quite important, especially for a company that is yielding near the 7% mark. We get a double undervaluation signal that we will come to shortly. And as we mentioned, they did just increase that dividend yesterday by 2.4%. Pretty poor in our opinion. That is below the inflation rate of around 4%. So dividend safety score was reaffirmed just last month, ultimately meaning in their opinion a dividend cut is unlikely. And when we get to this company and look at their key metrics from the last recession, that is the 07-09 crash, they actually cut the dividend, didn't increase it, didn't maintain it. They had above average growth, -6%, S&P -12%, and they also marginally outperformed the S&P, -45% return, S&P itself -55%. Now, very poor increase in my personal opinion this month. Over the last 5 years, at a bare minimum, they've been keeping it in line with inflation, and you could say the same for over the last 20 years. In terms of their growth streak, we can see 13 years of consecutive increases, and now we will get to the first valuation model, which is based on the forward P. Remember though, we're going to run it through our own model towards the end, so we're not looking at this one in isolation. Blue tunnel referencing the expected fair price. Right now we see it at the lower end, if not slightly out. That is an indication here of severe undervaluation. Then we move on to two other models. The first one, dividend yield theory, which tells us a company is undervalued when the current yield sits above the 5-year average. That is a massive undervaluation signal, well above the 4.11, but also one of the highest, if not the highest yields that this company has offered over the last 5 years. And in terms of the forward P, again, another indication of undervaluation. 10.1, lower than the 5-year rolling of 11.6, and we can also see it does trade at a massive discount to the healthcare sector of 15.5. Remember though, on this channel, some companies do deserve to trade at a discount. Likewise, some companies deserve to trade at a premium, but we want to understand, is this the case? Or in fact, should we be looking to take the opportunity because the market has potentially overreacted? So the first metric, very important as well, we're looking at is the free cash flow payout. Remember, on this channel, we tend to ignore the earnings data, which is susceptible to manipulation by management through accounting. Below 60% is what we want. Now, what we've identified here in 2023, something you couldn't see in the earnings ratio, 193% indicates that management paid out more in dividends than they generated in free cash flow. That is a red flag indicator, although what we would say is over the next 12 months, it is anticipated to come down to 68%, so something we would say just keep your eye on, because that will ultimately affect the possibility of a dividend cut, and as we have seen, the dividend increases at the moment are very small. In terms of free cash flow per share, we want companies increasing it over the longer term. Now, if you know the story about Pfizer, you will understand that over the majority of the period, 2014 to 2020, it has remained fairly flat. You got the increases due to COVID in 21-22, and then the massive drop-off into 2023. But over the next 12 months, and on a trailing 12-month basis, we can see some growth. So hopefully moving forwards, the company's numbers will turn around, but we will see a lot of this reflected right across some of the subsequent metrics. First one, sales growth. As we can see, remember 3 to 4% is what we want to identify just at the bare minimum so that we know a company is keeping up in line with inflation. Now, as we said, pretty much minimal movement from 2014 to 2020. Then we get a massive jump in 2021 and a massive decrease in 2023. So from a numerical perspective, we can in fact see where the growth spurts have been and we understand why. In terms of shares outstanding, as always, what we want to highlight here are companies that return excess cash through those share buybacks. Now, whilst we have noticed that Pfizer have done this over the last 10 years, we did clarify in their latest investor presentation, 2024, they've done none and they don't anticipate they will over the remaining quarter. Something, again, we can keep our eye on to see if they will introduce as a nice added bonus on top of this very high yield that the company currently offers. ROIC, one of our favorite metrics, now 10% or more. Reason why we say this, we want to see that management are able to effectively allocate their capital. Very inconsistent over the last 10 years, but near enough around the 10%. Whilst we get the massive drop from 2022's 29 to 3% in 2023, we can see on a trailing 12-month basis, it does look like it is starting to climb back up to the consistent levels we have seen around the double-digit rate of 10%. Now remember, margins, two things: one, above the minimum 12% that we get every year, bar 2023. Nice to see a trailing 12-month showing signs of an increase, but we also want to see efficiencies with margins increasing. Not something we have seen. Again, something we will keep our eye on, because ultimately that is what we want from high-quality companies. Not something we have seen from Pfizer, but then again, you probably wouldn't be surprised, given at the intro we did say they've been suffering from increasing their margins as well as their revenues. Free cash flow margin, whilst no real complaints as it is above the 5%, they did go through a period where it was very, very high. Again, something we would like to see moving forwards. Then one of the best metrics to look at dividend safety, the net debt to EBITDA, which reference the earnings before the interest, tax, depreciation, amortization. Reason why we say that, it does correlate to balance sheet strength as well as dividend safety. Now we want below 3 for the majority of companies, and remember the numbers below that you see are the number of years it would take the company to pay off all of their debt net of cash on hand. A very, very large increase from 22 to 23. Nice to see it has come down on a trailing 12 month. Nice to see over the next 12 months they do anticipate this to lower. And remember, one of the things they said in their investor presentation, they have recently been delivering the balance sheet, and that will help support any of the issues that we do have around the dividend safety, and hopefully that is something management will continue. Now we also want to let you know we have released our latest free weekly article where we run through one stock we are buying heavily this month. Now we release one every single Monday morning to your inbox completely free, where we highlight severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and start reading straight away, where you'll also be able to gain access to 28 undervalued stocks for the month of December. Lots of information for each one, as well as the upside that Wall Street themselves believe over the next 12 months. And you can also grab a recently released copy of 29 stocks that Wall Street themselves believe have the most upside right now in the S&P 500. So click below, you can sign up and start reading straight away. In terms of insider ownership, it's very low at 0.06%, and we do get one insider buying over the last year, around $108,000. We noticed in Q4, so the most recent quarter, 28,000 buying. Q3 no movement, Q2 no movement, as well as Q1, and then we get a little bit more buying in Q4 2023. Now we do say insider buying is a bullish signal, as management buy because they believe the share price will go up. However, you can also argue, one, this may be a little bit outdated, 30th of October, and the amount isn't that high, a little bit trivial at $28,000. But again, information is there if you want to use it in your own investment thesis. Institutional aspect, well, 68% ownership, around $8 billion worth of sales over the last 12 months, with a little bit more buying, $9 billion during the same time frame. But one thing we do see in the most recent quarter is more buying than selling quite significantly. So yes, over the last 12 months and in the most recent quarter, institutions are bullish on Pfizer. But remember, always do your own due diligence. Never copy what insiders or institutions do. Now, we've already flagged their top line revenue, which has been incredibly inconsistent over the last 10 years. But what we want to identify here is, what is the story being told to us on the bottom line net income? And for the large part, again, we do get a lot of inconsistencies. What is very interesting to note, though, is that massive drop off from 2022 to 2023. So again, these are things you need to consider, not only if you want to invest in this company, but also in terms of your margin of safety that we will get to towards the end. Then we're going to look at the health of the company, total cash versus total debt, and we can see their cash balance has been decreasing over the last 10 years, 36 billion in 2014, just under 10 billion in the latest quarter. And as always, these numbers or any one of them in pure isolation will not give anything away, which is why we compare it to their total debt numerically and directionally. And as we can see, it has in fact increased, and quite significantly just over the last year, going from 37 billion in 2014 to 68 in the latest quarter. Now, we did see the net debt to EBITDA being very high, above 3 in 2023. Definitely something to keep an eye on. One thing we do like, though, is that management have acknowledged this as a potential issue and are starting to pay off a lot of their debt, and will hope to do so moving forwards. We then have a quick look at how much cash they have generated from operation over the longer term, and we also notice, very similar to their top line, it is very inconsistent. 17 billion in 2014, 8.7, so quite a decrease, not just from 10 years ago, but also from the previous financial year. In terms of the metrics, first one we get to today is the valuation at an A. In terms of forward PE, 8.7, that is significantly lower than the sector at 21, meaning for those that are buying Pfizer at today's date, you are getting a 58% discount to the sector median. Again, question to consider, does it deserve the discount? Has the market overreacted? Or maybe it does to a smaller degree than what is being offered today, and we should capture this as a massive opportunity. And as we can see, no matter what valuation metric you use, this is just highlighting that Pfizer is trading at a discount to the sector median. Now look, I guess it does deserve a bit of a discount given the growth is very poor, a D-, negative 14% in comparison to the sector at 7. Over the next 12 months, forward looking, negative 14, again the sector positive at 7.7, and we can also see the EPS baked into this company over the next 3 to 5 years, anticipated 7% with the sector higher at just under 11. Profitability does look very impressive though with the A+. Gross margin 70%, sector median 58%, bottom line 7%, sector median -5%, and we can also see cash from operations 11.3 billion, whilst the sector median is actually burning through cash -15 million. So quick recap, this part of the analysis, we get a double buy rating from Seeking Alpha and Wall Street, and whilst we do get a hold from Quant, bear in mind 3.5 would flip them into a buy, so they're not far off. You could argue sitting on the fence. Valuation A, growth D-, profitability A+. Now 2 things before we jump into our own valuation process. First one, comparing them against other large pharma companies into the similar size. Now total return, including dividends reinvested, over the last year, they are down around 6%. Now pretty much the industry as a whole has lagged the S&P over the last 12 months. And over the last 10 years, we can see very poor performance, reinvesting dividends up only 25%, but we can see pretty much everyone, bar maybe Zoetis up 342, hasn't been that great and underperformed the S&P. Now we'll just highlight the comparative against the S&P, which is up 30% over the last year, Pfizer down 6%. In terms of the last 5 years, again, S&P up 91, Pfizer down 14, and over the last 10 years, S&P 194, Pfizer 25. Remember, we're highlighting this so you can think about whether or not you have faith that this company will be able to outperform over the long term. Otherwise, you may as well consider a low-cost ETF that does track the S&P. Now let's jump into the valuation model today, which comes to $35. It is the average of these 4 models. We can show you briefly how we did get to this price. We have Graham's valuation formula with the information inputted. That gives us an intrinsic value of $36, our first undervaluation signal. Bear in mind though, we're not looking at any of these models in isolation. We then have the multiples valuation model, average P with the EPS of Pfizer, giving us another undervaluation. Again, we have the dividend discount model, average growth 2.5. We have gone marginally high, given over the longer term, it did sit between 4 to 5, giving us a third undervaluation signal. And then the DCF model with the free cash flow year on year, average growth at 3%. We've gone in line with analyst estimates at 6. With the discount rate, we get the present value of future free cash flow and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as you can see, just over $32. And on average, it comes to $34.77. Now remember, on this channel, we always apply a margin of safety, starting at 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. Then it's a buy up to around $31, and then we keep going till it's near the current trading price. And what we can see in today's episode, you're pretty much getting not the 30% level just yet, sitting somewhere between 25 to 30%. In terms of Wall Street, they are fairly bullish. We did see the buy rating, their price target over the next year, $32.50, upside of 28%. So if for a company that is yielding near the 7% mark, 25% MOS at least, with 28% upside from Wall Street, is this one you are looking to buy? Give us your thoughts below. And don't forget to sign up to the free weekly newsletter, grab those 2 spreadsheets, and come and join us in a Patreon where we do talk about our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.